Welcome to Show Me the Money by Michael Derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, leasing, investment brokerage, all facets of the trade. What we're trying to do is kind of have an interaction with them so that you can understand and apply it to your business if you're whether trying to get into real estate or perfect some things in real estate or just learn some tricks of the trade. That's what really the podcast is about. So on this episode of Show Me the Money, we have Mr. Jerry Marcil here. Jerry's one of the largest apartment owners in Southern California between LA, Orange County, and San Diego. You'll hear the insight of Jerry from his management style, acquisitions, dispositions, development, his whole past, both good and bad, of what has happened in his career over the last 40 plus years. We're very thankful to have him here on the show, and I hope you enjoy the episode. I'd like to introduce my guest, Mr. Jerry Marcil. We actually had to cut his resume down in half for the interest of time. We'd be here all day. So, Jerry, thank you so much for coming.
Sure.
Jerry has over 40 years of experience in managing and operating a wide variety of properties. He started as a real estate broker specializing in the sale of condominiums, residential property, commercial income properties. His career sales have topped over $1 billion. In 1980, he founded a company, which I didn't even realize this, back in 1980, he founded a company called Property Dynamics, remodeling, development, and syndication of residential properties. And then he sold the company in 1989 and became president of Palos Verdes Investments, a development corporation specializing in development and management of residential property for sale and investment. A total value of the projects entitled and are developed to date exceed $1 billion. $1 billion with a B. The total value of the projects, again, $1 billion. PVDI has built or remodeled over 6,000 units in over 96 projects. He is involved in a dozen organizations and is currently the board chairman at Torrance, South Bay YMCA, who he does a ton of work with day in and day out, the USC Social Enterprise School and new majority of Los Angeles County. He is also a world champion outrigger and canoe paddler, and has authored a book called How to Build a Real Estate Empire. Again, we've cut this resume down significantly. Jerry is very active in the market and very active, very philanthropic, helping people. And so we're very honored to have him here on the show today. So Jerry, thank you so much for coming. We'll jump right into the questions right here. What has the last year looked like for you and the Palos Verdes team as far as investment, financing? What have you kind of seen in the market right now as far as apartments go?
Well, first, Mike, thanks for having me. I think I have to correct the 4 years to 40 years of experience. I think
40.
I think you said 40. Yeah.
40. Yes. Yeah. I misspoke for sure.
No, what's another 36 years?
Yeah,
anyway?
It's a rounding error.
That's all. It didn't happen that fast. I was just a 40-year instant success. That's
yes,
all.
40 years.
Yeah.
Yes.
Okay, but I had my ups and downs and actually been broke twice during that period of time.
Wow.
But now have 4,000 units between LA and Orange County. So
that's amazing. Very impressive.
Anyway, well, I'll go back the last couple of years, because in the last couple of years, as prices have been going up as fast as I can ever remember. The market was white hot, and I'm talking about apartment buildings. I know the market was white hot for industrial, which is not my forte. And then office has suffered a lot because you have to look at the COVID and how people learned how to work from home.
Right.
And so I think that market will be soft for some time. I won't get into that. I have invested in some retail centers that were very distressed. So if you can buy it at the distressed price and put the right tenants in, you can make money at that too.
Right.
I saw the prices going up at plus 10% a year over the last couple of years. I mean, maybe in some of the properties I looked at, 2 years it probably went up 25% in my field of apartments. However, it's dropped pretty significantly also in just the last few months, as I'm sure you're aware.
Right.
We're talking about probably the last 6 months have just been marching down. They could be down as much as 10% from what I can see.
Sure.
However, we should be happy. We're still up over the last 3-year period.
Right.
And that's what I've seen. I've seen, we're looking at interest rates. As you know, you made me a loan at the beginning of this year 3.2% on a 108-unit building in Torrance.
Right.
3.2%. But I would say there were loans available at 3.5. And I think, if you've got incredible credit and everything, you could probably get a loan in 5.5, 5.75 rate.
Right.
But we're looking at each point on 3.5%. Each time it goes up a point, your payment goes up about almost 30%. Right?
Yeah.
1 divided by 3.5.
Right.
So I expect that things are going to shift.
Right.
Unless you got all cash buyers, but it's definitely a buyer's market now, and probably will be for the next year. I don't think that interest rates are coming down anytime soon.
Right.
Fed's still telling us that they might raise it a couple more times.
Exactly. They're going to keep raising the rates. They're tightening the balance sheet. That's really what's happening day in and day out here. And the amount of capital sources as well, on top of the tightening the balance sheet, on top of the interest rates, the amount of lenders in the market are being flushed out by the day. I'm getting calls probably every 3-4 days. Well, we were in the market, now we're out of the market, now we're back in the market. So for us to monitor that in our capital group across the country, we have, 200 of us across the country in all 50 states covering it, sharing ideas and lenders who are in and out. It's hard for us to keep up with it, let alone a sponsor like yourself who's very well vested in the market. So we're doing all we can, to keep up with this, but it's challenging right now. The headwinds are there, but the good news is someone like yourself, if you have the ability to pay cash for a property today, and if you have a willing seller that can meet the market, I think it's going to be great. You made a great comment earlier too about the interest rates going up and how much that's going to correlate to your payment. So I don't see properties, and you don't either, obviously, with rent controls and all these different things, government intervention in place today, that are obviously going to have a huge impact on these deals today. But one thing that's really interesting, we haven't seen a ton of supply come to market. And so I wonder, Jerry, what is your take? Do you feel that, you've been through so many of these cycles now, and do you feel that more supply is going to come to market? Obviously we look at motivated sellers, death, divorce, partnership dispute, a major health issue, maybe a fund that's sunsetting. Those are maybe the 5 things that are a motivated seller who are actually going to meet the market. But aside from that, do you see people who are actually going to be exiting multifamily real estate in Southern California, where is really your forte?
Well, I'll give you one more reason that the people will exit the market. If they took a loan 5 years ago,
good point,
at say 3.5, and it becomes due sometime in the middle of this year, which I expect will happen, and they have to take a loan at say 6, I think that's a 70, almost 80% increase in your payment.
Right.
It may not cover, and it's harder, as you said. I've talked to banks, and banks are running scared.
Right.
They're asking for my 3-month trailing, P&Ls and things like that, and trying to find a reason. They know I have some cash, so they're trying to get a reason for me to pay it down.
Yep.
But, so far, so good. But I've had a couple of lenders waste my time on that, and
yes.
So they're running scared. But I do think that you'll see more supply in the middle of the year. But it's only going to be people that have to sell. They're not going to sell unless they have to sell.
Right.
Or they got to be very motivated. And right now, I don't know that they've found the market yet. The market has not, still dropping, and it hasn't leveled out. I'm thinking it'll level out sometime middle of the year, or maybe even as far as the beginning of next year, but in that zone. But I think it's going down until then. And so, sellers don't want to sell. It's a hard thing for the sellers right now.
Right.
And, if I could, and I can, fortunately, I'm going to hang on. I'm not going to sell. Of course, I'm not really a seller anyway.
Right.
You're
a buyer.
I like to hold long. I'm a buyer.
Right. Of course.
Yeah.
You've obviously done very well and have added value, bought properties maybe a little distressed or not managed properly from REITs and a lot of different institutions, large private clients over the years. You've repositioned them, got those rents up to market, gave a great place to live for people that effectively, maybe were living in not squalor, but not in a great position like you have for your property. So you've done a very good job on that basis. And I think that, the foreseeable future, I think that, clients like yourself are going to be able to take advantage of things in this market, obviously, to be able to take advantage of being able to, again, to pay cash for properties, because when sellers do meet the market, that's what's going to be, the case where you can come in and capitalize on that opportunity. So with that being said, obviously you're looking at the growth happening maybe mid 23, late 23, but do you think that the Fed is going to reverse course? And if so, and reversing course, do you think they're just going to settle down, or do you think that they're going to actually, start to lower rates again? I mean, politically, obviously, things get very political, as you know, being very tied into the new majority and whatnot. You see what happens here. What's your take on that?
Historically, after an election, that's when rates go up, because the party in power usually likes to keep those rates down and they didn't this time, but typically they wanted to keep it around. And then afterwards is when you see the increase, because they want the economy to be booming so people vote. I think that the Fed goes too far in one direction too quickly a lot of times. That's their MO. I mean, they should have saw this coming in the, when they printed $5 trillion of unearned money. It was not backed by taxes.
Right.
During COVID, you got just more sheets of paper called money chased the same amount of goods and services. Actually, probably less, because people weren't working, so there was less goods and services and more dollars, but they were not backed by anything. Yeah. So you're going to get inflation, right? So, so they went too far in one direction, because I think one of the loans you got me was at 2.5%.
2.47, but no one's got full term IO.
Which was for 10 years. And that isn't going to happen again. That hasn't happened in history, and it probably won't happen again. But, COVID actually was not such a bad thing. If you were refinancing, it was a great time.
Right.
But they went too far, and now they go too fast, too far the other way. So I do think that they will see religion, and I think that'll be near the end of 2023. I do think they'll start bringing rates down in 24. I don't think they can go that much farther.
Right.
And typically these types of recessions I think we're in a recession, even if Mr. Biden says he'll tell us what a recession is. I think we're there, and I think it'll probably get worse before it gets better. But I've seen these cycles. I've been around. Actually, I had my real estate license 44 years ago, so I've seen these cycles. Typically, a property out of a 10-year period will go down for 2 of the years, and typically goes up for 8 of them. So, if you can survive, if you can think long and buy, and think long and hang.
Right.
I've bought properties in markets like this. I'm still looking, because I'm a deal junkie, but it's interesting to watch. I'm watching, the prices come down. I need a little more patience.
Sure.
Not something you want to hear, but
no, hey, I totally get it. But the other thing too is your economies of scale. Buying a property, sometimes I think we see some clients looking to do this right now, where they may not typically look to be buying a property right now, but given it's next door to a property you own, and you can do economies of scale in your management, right, or any kind of your maintenance or payroll, obviously that oversees that, you could be obviously looking at that deal much differently than say that I'm buying that deal, which I don't own in that market, say in Torrance or whatnot, that you're very well heeled in. And those things right there could be great opportunities for clients today to take advantage of other properties, close by to yourself.
You're 100% on that, by the way. You're right. And I, well, I should put this. I mean, I've bought high, and I've bought low, and I've bought in the middle. Anybody that tells you that they can predict the best time to buy, if they had that crystal ball, they'd own the world.
Right.
But I don't buy something that I can't. I mean, if I'm going to buy high, it's got to have some upside. As long as you can hold on through any recession, that's the stopping point. I won't over leverage. But like you said, if an opportunity comes right in my wheelhouse, what I'm looking for, even if I think that the market is soft, I might buy it, because it just fits what we've got to do. Or like you said, next closer building we're already managing, and we have a manager that can manage it, and maybe we can be the high bidder.
Right.
Yeah.
And obviously, when you've told me this over the years, and just to talk a little bit about the past of Jerry and I, first time we met was in 2009 on a portfolio you bought here in Tustin from SunCal. Property was in distress. There was 144 units here on Red Hill and Mitchell. I was cold calling Jerry for years and trying to, earn his business. And 2009 comes around and it's just crickets everywhere. We were still doing deals and still working actively where a lot of the big banks were out. My team was very active and I was very thankful to still be in the market. Jerry calls and says, hey, calling me, by the way, not me calling him, can you get me a loan? And I said, is this a joke? Is this like, is he messing with me here? And so long story short, that was the first deal we did. It was through Luther Burbank Savings at a rate of 6.05 on a 5-year fix with 5 years interest only. I remember the Lynn Carpenter, who was there at the time, no longer working for the bank. And she said, you have, here's the term sheet. It was 9 a.m., 5 p.m., it'll no longer be good. Let Jerry know. He would sign it and wire the monies in. Otherwise, the deal's off the table. And that's how it went down. And we're actually seeing some of that come back today because lenders want to make sure they're in and out. And the amount of liquidity that lenders need too is obviously stacking up right now because obviously given things are a little bit out of line in the market, people are looking at alternative investments and different alternative money center banks investing in treasuries and whatnot. So we're starting to see lenders wanting deposits. So effectively they want to lend your money at a higher rate. So that's what's happening. But
that is exactly what I'm experiencing. They're
Right.
even calling me to say, hey, if you put some money over here, we're at 2.5. And then now I heard another bank call me and say, okay, we got a special money market for you, 3.5%.
Right.
But you can still make money if you're at 3.5% and you're lending it out at 5.5.
Right.
So they could still stay in business.
Sure.
But looking at the negative leverage you would get from buying an apartment building right now you're down to maybe a 2% starting return on your money.
Right.
Because you're borrowing at 6, you got a 4 cap rate, and there's a gap.
Yes,
You're going to have
exactly.
a negative leverage, and I don't know where that gap is going to settle out. I could see some gap, but the gap is too big right now.
For sure. I mean, no one really knows, what's going to happen in the future here, but I guess obviously to be proactive instead of react in this market is really what it's all about. Since we closed that deal, Jerry, back in 2009, we've done in excess of, I think it's $700 million together in financing. So our team is very thankful for the opportunity, and it's been very, mutually beneficial for everyone. Everything from commercial bank financing to agency financing, CMBS financing. And so thank you for sticking with us and allowing us to navigate the market as these markets kind of come and go. And the lenders really come and go rather than the market. So I guess the market is coming and going as well. But, the nice thing is to have people thick and thin like you've done and been very successful and just holding the line and making sure and focus on what you know rather than what you don't know. And obviously you said earlier in the conversation here on the show, you were saying there was some times where you weren't as successful. And maybe if you want to touch on some of those things, I think maybe in the construction or development side of things.
Well, okay. This is before your time, but in the early 80s, when you were trying to get a loan on your house, the loan was about 17 3/4 for a 30-year fix. And you can't make that up. Prime rate was 21.
Right.
And I was getting 22% in the bank on my CDs, in the bank. But I had a development going on at that time, and it was similar to this situation where people couldn't afford the new interest rates by the time I got the development done. And I was almost wiped out financially on that one. But I made my comeback. And then in the early 90s, I guess it started in September of 1989, but it just went really off the charts, especially in LA County because, interest rates, though, were at about just under 10 at that time. And, I had over-leveraged on several properties, and the recession hit in LA County because of the war, the war in Iraq, we had, everybody found we're based on defense industry. People don't realize that the largest employer in LA County is this aerospace. It was 440,000 employees in one business.
Huge.
They cut out 200,000, so not quite half, but close to that.
Significant.
And my sister was in that business and barely survived. She was one of the ones that barely got out.
Wow.
So it was a recession in the rest of the country. It was a depression here, and I had to sell these units that I had built. 3 big condo projects, and I had to sell them off at auction. And I had a negative net worth after that.
Wow.
My net worth was less than zero. So, and then I said, God, if you give me one more real estate boom, I promise you I'll know what to do with it. So I stayed in the development business, but every time I did a development that was successful, I'd take half the chips off the table and buy a lowly leveraged apartment building.
Okay.
And I kept doing that until I burned out in the development business in around perfect timing, around 2006 or something like that, just in time
Right.
to not get beat up again.
Great timing. Yeah.
I
'cause then
finally guessed one of them right.
Right.
One of these cycles right. I got myself liquid, and
Sure.
the rest is history. I've been buying. I mean, I have to thank you. You're saying, well, you're thanking me for the $700 million in financing you did, but you probably don't want to hear this. But I bid against you, and you always came out as at the best rate or the best deal overall.
Thanks.
So,
Yeah.
I
No.
don't know. Because you're an animal. You're probably one of the few people I know that work harder than I do.
Oh, that's funny. Thank you. I have a great team with me, so I'm very honored. We have a great platform, that we work with, and our lender base too is very strong. And the relationships over the years, we're very blessed and very fortunate to be able to execute the way we do. So it goes both ways on there. So with that being said, what would you? Well, actually, I just want to touch base on one thing. Did you see this one coming? Did you see the Fed going so aggressive so fast in the past year? Obviously, after throwing that $5 trillion out and then ripping that out of the market so quickly overnight, did you foresee this coming that quickly?
No.
No.
I didn't see it coming that quickly.
No.
I saw something coming, but I think I was thinking like when the Fed normally acts 0.25%, for 90 days, and they see how they wait 90 days or 180 days and see how that worked, and then they do another 0.25%. But man, when they came back with it 3/4 and one of them was 1%, and that quickly
4 3/4 increases, like boom, 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 like that,
Yes,
and
I
tightening
know.
the balance sheet.
So
it's a double whammy. So it actually correlates to like 1.25% each time.
didn't see it coming, and I had 2 buildings that I do want to sell because they're not really part of my portfolio. They were just kind of in and out deals that we were going to do. But one is down in San Diego, retail, and then one is in Santa Monica, which you know about that one. And,
yes.
Wasn't my type of management, but anyway, I don't know who saw that coming, but if they did, they could have really taken advantage of it.
Right.
Yeah.
I don't know anybody who saw this last one coming over the past year or so. It's been a very drastic change, and everyone in the real estate industry across the board that is probably going to be listening to this podcast obviously will have some heartburn in some form or fashion of their business. Anyone who has been stronger in their business, I guess, over the last 6 months, I would kind of question that, unless they put in a large single tenant, maybe in a space that didn't, go or whatnot. But like you were talking about office property, those office properties, a lot of tenants are downsizing right now. A lot of people are subleasing. Industrial properties are starting to tip right now as that goes, as well as manufacturing starts to lighten up. Multifamily, I mean, how much more can people afford in rents to pay, the mortgage here on higher mortgage rates? It's just across the board. But in order to be proactive here and not over leveraged, I think it really is the key to see what's what. And if you don't know where the market is on pricing today, you don't really know how leveraged you are until you know the price at the end of the day. But the value of the real estate is only when you're buying, selling, or refinancing. Otherwise, you've always told me the value really doesn't matter. It's all just a paper number anyway. But again, if your leverage point is high, then it's all about that mortgage payment. And interest only is a huge benefit that people have taken advantage of. Full term IO, or at least 3 or 5 years interest only, because your payment's about 40% less, which is huge. But if lenders start to pull the interest only off the market, which we're seeing depending on the leverage point on deals right now, it's challenging. One deal in particular we have right now under application, we have a rate locked at 4.73, and the cap rate on it is 5.28. It's a brand new 128 unit building right here in LA County. But, those rents toppled all, or any issues happen, and all of a sudden we're 1-to-1 with cap rate to interest rate. And then your leverage point at 62% that this deal is under contract right now will, could potentially foresee issues in the next year or so. But, we'll see where things go down the road. What would you, kind of transitioning, if someone was getting into real estate today, what your words of wisdom and advice, having been in the business now for 40 plus years, what would you what would you advise them of someone getting in or investing or being a broker?
Well,
or what would you recommend?
if I had it to do over again, I would have started out trying to grow a little slower than what I did, because I was leveraging to the max. I didn't care about the interest rate. I just wanted the max loan to value. Now, as you know, I'll put in an extra 5% down, or maybe even more to get the A rate. And if you look at that last 5%, so if you save even 25 bips, that's on the whole loan.
Right.
That's on the whole loan, not just that last 5%.
Right.
And so that gives you more staying power through a recession. So another 5% down rather than trying to get the 75%, maybe you go to 70. And in my case, as you know, I'll go down to 35%. And then I'm talking about a normal market now. Right now, you'd be lucky to get 50%.
Right. It's 50 to 55% down.
That's right. That's what it is right now.
It's, that inversion with cap and interest rate obviously doesn't correlate to leverage.
The hard thing to do is watch, your money. So even if the bank's offering you 2.5%, it's hard to put it in there when you see inflation go by at 8.5%.
Right.
You want it into hard assets. You want to get it into hard assets. If you own a house over time, don't panic right now because the prices came down. Over time, that is a heck of a hedge against inflation.
Right.
But yeah, at this point, you need a little patience. It's hard for me because I'm a deal junkie. But since I've done this before, I know that's what I need to do. Right. Although I still look. Right. And I can tell when I see that the market has kind of caught up to it'll flatten out.
Right.
So then I'll be very aggressive when I see the prices kind of flatten out. I'll get more aggressive because I know that the up is coming. Because like I said, I've been through 44 years, and then it's on average, the cycle is about a 10-year cycle. So I'm just averaging again. Don't hold me to that. But like I said, it might come down it might even come down 3 years in a cycle. That's kind of unusual. It comes out more than 2. But you're going to get 8 years of ups, and it's going to counter that. And cost of construction is huge. So you got to look at it that way. Oh. Having been a developer, that's why I like to buy, existing buildings. I look at the cost per square foot I'm paying on an existing building versus what it costs to build new. And I'll take the existing building every day because I can fix it up to make it look like a brand new building. Right. And it's way cheaper and way less.
You don't have to deal with the cities or the contractors. You don't have to deal with
and you're making
permits
and you're getting rent. Well, you're not just holding.
You don't have to do it all at once.
Exactly. You're not just holding property that's not producing anything until it's completely built out. You're just carrying it. Sure. And you buy an older apartment building and fix it up, it's still, there's rents coming in while you're doing this.
And you could do it over time as well instead of the construction. You're either building it all, getting your certificate of occupancy, leasing it up, getting out your construction loan or the bridge loan you're in, and then getting that perm loan. I mean, you're really under the gun to perform on that basis. So I think obviously your model, it's obviously proven to be extremely successful. And, seeing people in these construction projects today, people finishing construction now or in the next 6 months, it's a little challenging because a lot of people can't take out these construction loans now. People were forecasting between 4 and 5% takeout interest rates. And now with rates, between, 5 3/4 to 7% case by case on the project, those numbers don't take out the existing loan. So some of these people will be forced to sell or will be forced to do a cash-in financing basis in order to get out of that construction loan. That's given if they can stabilize it and not offer a ton of concessions to get people into these buildings. And we're starting to see in certain markets across the country now that, concessions are becoming much more prevalent and people can only afford so much as far as the income goes relative to their wages. And I think layoffs now are going to start to be happening more and more. Unfortunately, I hope I'm wrong, but I think companies are going to start to trim the fat and downsize more as the cost of everything is going up relative to the Fed and the cost of capital that, companies have to operate on. So I don't know if you want to touch on that at all.
Well, one of the things we're in the labor market that we're discovering is very hard to get tradespeople. Right. The people that are coming over the border right now aren't like the ones we were getting 20 years ago. I mean, they're simply uneducated and don't have a skill yet. And a lot of the ones before that came across, we got when they were, I would say, people coming from Mexico. I have a lot of those people working for me. They've been great, but they're not teaching their kids the skill. They don't want their kids to have that skill.
Okay.
They get them through the public school here, and they want them to do something else.
Got it. Okay.
And it's very hard to get. So that is also in the construction business as well. Right now I would feel sorry for people that are like in the framing stage of something new. I don't know that. Well, maybe it'll take them with trying to build in California. It takes so long, but maybe by the time they're out, rates will be down again. So I shouldn't feel that bad about it.
Sometimes when you build through a bad cycle.
It's very, very hard to build here.
Right.
That's what's going to make your apartments worth more. You just got to worry about government interference on your businesses. They will regulate it more and more as that cost goes up. But it's very hard to build in California for lots of reasons. I know people aren't on this podcast to hear about it, but I was a developer.
Right.
And wow, you could build a house in Texas in 4.5 months. You're lucky to get that house built here in 2 years, same house.
Well, especially if you deal with like coastal commission.
Well, you got to deal with all kinds of things in the permitting process. It takes a lot longer. We got CEQA. It takes 18 months to get through CEQA at a minimum, and can be years at a maximum.
Right.
And the whole time you're just carrying the project. You're just paying money out. And
yes. Fees.
Yeah. So that's why the value of these apartments is going to go up, because my belief is that if you're within 10 miles of the beach and you're in between Santa Barbara and San Diego, that's the best weather in the country.
Yeah.
So there'll be a buyer, there'll be a tenant at some price.
Right.
It won't be like being in Bakersfield or some tertiary market.
Sure.
So if you think long and you buy in those areas, I think you'll be okay. You just have to worry about government interference.
Right. Like was it LA County or LA City? I forgot which one. They just passed this new proposition where if it's $5 million or more that you own a piece of real estate. LA City. It's 4.5% increased tax. Yeah. If it's 10 million or more, it's 5%. Yeah. So immediately, as of that moment, it passes. $10 million or more, your value of real estate went down by 5%. Yeah. And then $5 million, between 5 and 10, the value went down 4.5%. And people have asked me like, well, how does that affect the value? And I'm like, well, what do you mean? How does it affect? Your value just went down, relatively speaking, by 4.5 or 5%. There's no gray.
Yeah, that's why you don't sell. It's like being in the mafia, you can't get out. Once you get into this business, you can't get out, because after you refied a couple of times and you've taken enough depreciation, unless you do a tax-deferred exchange, you're in it for life.
Right.
Because you can't get out.
Exactly.
The government would take all of your money.
Right.
Yeah. They take. Yeah. They consider all the depreciation you took as a profit.
Right.
Yeah.
Yeah, that's a little bit of an issue, I think, for investors. So.
Yeah.
Long story short, buy, hold, reposition, buy again, keep buying and buying, so that's...
Well, you hold long enough that your property tax looks a lot lower compared to your income.
Sure.
When you first buy, it's about 20% of your income is going to pay property tax.
Right.
And that's just, well, you got to have it, because you got to have schools and policemen and all that. And,
sure.
It probably 40% of the income you bring in goes to pay the loan.
Right.
So you're at 60% right there, and then there's a lot of other expenses.
So if you're not managing your variable costs, you're going to be in trouble very quickly.
Oh, yeah.
That's all.
Yeah.
And then if you're not on an interest-only loan and you're on a principal and amortizing loan, things can get very interesting very, very quickly, regardless of the leverage.
I like those interest-only loans, because even though I may take a lower loan-to-value to get the good rate, it's like getting more it's like a higher loan-to-value, because after 5 years, you're using all that principal payments for other things.
Exactly.
In places where it could be 10 years, you're using all of that. And when you add up all of those principal payments, your loan to value is a lot higher on that interest only.
And you're increasing the value. Obviously, you're a huge believer of putting money back into your properties. All of your properties we've financed, I mean, we haven't had any issues. Every lender has been very pleased. I mean, little things come up here and there, but overall, you take care of properties. The one thing that we experience sometimes with our investors over time is that people let things go and deteriorate them, and like, well, I'm not going to charge a top rent. I'm just not going to do anything for the apartments and whatnot. Well, your lenders come in and say, well, I don't know if I want to be your 50 or 60% partner, because that's what effectively it comes at the end of the day, that your lender becomes your partner. Do you want to be partners with someone who's not going to take care of their things? And the answer is probably not. And the lenders look at that and ding you, or just may not do business with you. The nice thing with you put money back into the property, you make a great place to live for the people and the tenants, and obviously your lenders pay that off, and it helps you be more successful, get more cash out, get longer interest only, and a lower interest rate. And that's where the execution is, so.
Again, you're 100% on that, 100%. I will put a little more emphasis on, though, it's great for, borrowing money as the lenders see that you keep up their asset, because they're looking at the asset.
Right.
But also your life is a lot easier when you put in good tenants.
Yes.
And you can't keep good tenants. You can't get good tenants unless the place looks good, unless it looks clean. 83% of sales is visual. 83% of all communication is visual, according to the scientists. And so in order to get the right people through the front door and be able to screen and keep good people, that makes your life a lot easier. And it pays off. It pays off to put money back in, and that's what been my experience anyway.
Right.
But I see other people do it a different way.
Yeah,
and everyone's different. They got their methods.
Sure. Yeah. Some of those people are churning, but if you're a long-term investor, you're just really investing in yourself at the end of the day. So that's a great feature. Are you starting to see, Jerry, one thing is that, people are worried about a recession, and, I think you and I both agree we're still kind of in it right now, but are you starting to see more slow pays come up? Are you starting to see vacancies take longer? Are you starting to see more delinquencies? Are you starting to see that across your portfolio?
Yeah, in the last 2 months, 4,000 units. 2 months ago, our vacancy factor was 2.5%. My goal is 3% actually, but now we're at 3.5%. It's jumped in just 2 months, 1 point. That's a lot on 4,000 units, because that's 40 more units that are vacant, right?
Right.
The market doesn't decide our vacancy rate. We do. It's a matter of what we charge for rent. So we get over 3.5 or 3%, we think we're asking too much. We get under 3%, and then we think we're not asking enough. And so you got to have your own. And that's just my number. Other people have their number, but 3% for me is what my target is.
Okay.
Yeah.
Well, you're a pretty good barometer. I mean, you keep your occupancies high. Other people try and ask for top rents, and their loss to lease is too high. Other people are too cheap, and they keep their building full. And it's like, weird, I never have any turnovers or anything. It's, well, because your rents are 10% or 20% below market. And if you've owned a property for the last 20 or 30 years, and your cost base is low, your taxes are low, your mortgage payment's low, you haven't leveraged up, you can afford that. But it throws off the whole neighborhood for everyone else who just bought their properties in the last year or two, because their mortgage payment's high, their taxes are high, so they have to charge more, or they're remodeling units. They're putting $30,000 to $50,000 in a unit on a remodel. I mean, someone has to pay for that. So that's how it all correlates.
Yeah, and it's not an exact science. Sometimes I call it an art form, but you have to experiment with certain things, because sometimes having that a little bit lower vacancy factor, so that means you're not charging as much as the market,
right?
But your turnover is less, and so you got less expenses there.
Sure. Sometimes
we're more aggressive. I mean, we've been more aggressive lately now because I think we're in a recession, and I see that it's gone up a point, and maybe it'll go up another point, the vacancy factor. But what we might do is not fix up a unit as much as we did before. We might have, say we have 4 vacancies at a property. We might fix up only 2 of those, and the other 2 just clean and show and be in 2 different markets for the rent.
Right.
So keep them full.
Sure.
Not all of them. Plus, it takes a long time you lose rent while you're remodeling a unit. So it allows us to be in more than one market at a time.
Right.
Yeah.
Yeah. No, that makes complete sense.
Yeah.
I guess one other thing to touch on is you've been so philanthropic over the years, with the Torrance YMCA, which it's impressive to see what you do with them to help those families, the elderly people, and the children to go to camp every year. Is the heartstrings that you pull with that, and how generous you are with that organization. Can you maybe just touch on that. I think that's probably your most important organization, and kind of how you got involved in it and why it's so important to you, and how beneficial.
Well, it's the one I've put the most money into, but it's because of a personal experience. Growing up, my mom was in and out of mental hospitals, and we were broke because of it, so we didn't have any money, and I wanted to go to YMCA camp. Somebody down the street heard about it and called the Y, and somebody from the Y came over to our house and said, here, if you sell these peanuts, they gave me like 2 cases of peanuts to go door to door to sell, you earned your way to camp.
Wow.
And so, I was a shy kid, but it got me out of my shyness because I really wanted to go. I had some friends who were going, but their parents were paying for camp.
Sure.
Camp was pretty expensive back then. It was like $35 for the week.
Wow.
And I know our house payment was $77, and my dad didn't know how he would make it every month. So it tells you how much camp costs, half of your monthly payment just to send a kid to camp. Anyway, I sold the peanuts. I had no idea that it didn't pay for the cost of camp, but it gave me some self-esteem about it. And it wasn't until later, as I get older and smarter, and somebody had come and asked me for a donation to the Y, and I think I gave him $100, and I gave him my story and everything, and they just laughed. He goes, yeah, you made about $7 or $8 selling those peanuts, and the cost of camp was $35 or whatever. I go, yeah, so. And then somebody asked me to be in the Major Gifts campaign, and the rest is history. And a couple of years later, I was on the board. I was a camp counselor. I was at the same camp that I went to. My kids went there. Anyway, the camp got run down, and during the recession of the 2007, 8, 9, people weren't going to camp, and we couldn't afford the cost of keeping it up. So, yeah, I put in a lot of money. I'm not going to say, but it's in the millions.
Very significant.
Significant amount of money.
You've helped that organization exponentially.
Camp actually, I didn't want them to do this, but they just wanted to do it so bad. They named the camp after us. Well, I tried to talk them out of it 4 times.
Wow. Well,
so anyway.
You've done so much to help these families, and again, my hat's off to you for that. It's really impressive, and the families are very thankful, and it's been so beneficial. Can't thank you enough. You're a very, very giving person. You really give back. You help your staff that works for you is amazing. They love working with you. They speak the world of you. Jerry takes his whole team on a trip once a year, charters a plane and takes them out with their spouses. And he's probably one of the most unselfish investors in the business. And it comes back to you in spades. So it's impressive.
Yeah, I mean, it's at the end of the day, it's all humans.
Right.
It's all about the humanity. So, you really have to look at that part of it. That's part of the business. And some people just lose that. They lose that factor.
Right.
But in order to be successful, you have to have people who want to do the work.
Right. You can leverage technology, but it comes down to human interaction at the end of the day of getting deals done. So it's great, Jerry. I can't thank you enough for being here. One last tidbit, for 23 coming up, I know you talked about some headwinds coming up here, but are you bullish on 23 and 24 coming up? Are you a buyer, a seller, a refinancer? Who are you in 23?
I'm kind of excited to see what's going to happen, and I think I'm going to be a buyer. I'm always a buyer.
Right.
I still got my ear to the railroad track every day. I don't know why I can't get out of that. It's who I am. It's in my DNA, and I'm excited to wait to see. Like I said, with the people who have to refi, they may have to put money in, they may not have it. So I think some deals will come up, and I see the market at some point will find itself in 2023, and that's when I'll get aggressive. I'll see it stop going down anymore, and I'm going to start buying.
Right.
Or I might even buy it on the way down, because if like you were saying, if it's something that really meets my goals, my strategy, sometimes, as I've outbid people, 22 bids on a property, and I'll bid them all. It's because it was in my strategy to do so. So, I'm always
optimistic.
Going to be, and I'm never going to retire. So I love what I'm doing.
It's great. You never work a day in your life if you love what you're doing, right?
That's true. I can't say that it's all easy. I mean, if it was easy, everybody would do it.
Right.
There's those things but I do them because I know that deep down, I want to do them because I want to be successful at it. So those things that aren't glamorous, you have to do those things
Right.
if you want to be successful. It depends.
Like management. Management's the key of everything, especially multifamily business. It's imperative.
Just a quick example. So I have friends that think I'm batshit crazy because I would spend all day trying to figure out how to save $10 per unit, say on water. So we put in low flow shower heads or something like that in all of our units. I go, and my friends would go, why do you do that? I go, well, $10 a month per unit times 4,000 units is $40,000 a month. Times 12 is $500,000 a year. If I can borrow at 5%, that's $10 million I made that day on $10 a unit. So I tell some of these people that are growing, like, Mahendra.
Oh, yes.
He's growing. And I just say, it'll come a point where management will be more important than finding the next good deal.
Yes.
And it does.
Right.
It becomes more important because it's spread out over so many, properties. So
it's exponential.
It's exponential.
Yes.
So the actual time spent in management, to me, is more important now than hunting the next deal. Although that's important.
It is.
Because that's where I really do enjoy and getting excited. But the management actually makes me more money to spend time there.
Yeah, and you're good at it, and obviously you've mastered the craft. So, Jerry Marcil, thank you so much for coming. I can't thank you enough for your insight, your wisdom, and your tricks of the trade that most people have no idea what it takes to day in and day out, and the grit and the give back you do for your team and others that are in need. So it's impressive. I'm honored to be able to work with you and continue to do business with you, and our team is as well. And I wish you all the best and success for 2023.
Well, thank you, and ditto back to you. Really enjoy working with you, and hope this goes on as long as I'm working. So
yeah, me too.
Hope our relationship goes on like that. Yeah,
excellent.
Cool.
Thank you, everyone. That's a wrap. Thank you.